Ladies and gentlemen, welcome to our financial show here on IBM TV. My name is Sasha and I would like to introduce my esteemed guests. It's um, the founder of the IBM TV network is Nick Paliveda. Welcome, Nick, to the show. And my co-host,
I bring my fan club.
he's hailing from New York University with esteemed degrees in finance and many years on Wall Street. Welcome to the show, Peter Bennett. How are you, Peter, today? Okay, so we are now at, is it correction time or just a little hiccup? What's in the market now? My scenario was that market would go down this week. And in fact, I even suggested to sell some, and I did sell some of my positions. But I thought that we will be back on the market on Thursday, but maybe it started the day earlier. Peter, what do you think?
Well, you made a great call, Sasha. I don't trade the market like that on a daily basis, but you called it exactly. I mean, it went down a lot, and I did make an adjustment or two. I got out of some lower yielding stuff anyway because I was nervous about the market. But you called it that it would be down last week, and it went down really well. And you said Thursday, buy. So today's Wednesday, and the market's booming, and it's been picking back up. But it was a little swing. It's I mean, look. It's the same three things. COVID, first of all, fears, but, inflation fears and the tax proposal, which you don't always hear about, but people are very nervous about that. In terms of COVID, and then we have a new one with China, but none of these things concern me in the long run. But with COVID, the interesting thing is I heard the drug companies are developing a pill now. So it's going to be an oral pill. It may take 6 months, a year, whatever, till it hits the market. It may not work quite as well as a shot, but it's going to have a big effect and, help fight COVID. And in the end, people are going to adjust to COVID one way or the other. They'll travel again, everything like that. And in terms of inflation, there's been the CPI has been up 5%, but the producer price index was up 8%. But I'm not even concerned about it, really. Stephanie Pomboy, who I really like as an analyst, she writes in Barron sometimes, other places. I see her on TV. She makes the point that during the inflation of the 70s, there were real wage gains. But she said, but now, even though now there's some wage pressure, wages have been going minus 6% real. So people don't have more money to spend. Even in the last few years, they have less money. So that's my forecast for the rest of our lives, basically. Very low yields with inflation eating away, but still not outrageous, and I heard a term that was really great in one of the article I read today. It was that we're in a yield desert. It's a great term. I love that term because that's the thing. Where are you going to put your money? I mean, even if there's inflation higher than interest rates, the Fed is giving 10%, to the 10-year, they're giving 1.3%. And then, and then there's this China panic too, by the way, which then, there's been trouble in China all year. First, they attacked the tech companies. The Dragon Fund was down 50%. The China index was down more than 25%. Alibaba, I read a report on 13F filers, more than 8% of their money got pulled out. Everybody's nervous about China before. Now you have a real estate crisis. So Evergrande has debt that's equal to 6% of Chinese GDP by itself. That's a lot of debt. But they're not alone. The other real estate companies are also going to have big debt problems, very likely. And you know what? This is when you get a managed economy. I don't, and why the U.S. wants more government involved in the economy, I have no idea. But, they make good decisions, but they make a lot of bad decisions. And in the end, it doesn't work well. So, but I'm not worried about China in the long run. I think China will have problems. I'd not invest in China. I wouldn't be anyway. But in the long run, we're all heading the same way, which is the long-term you can't fight the demographics of an aging world population, increasing technology, and debt. All huge debts that they're going to have to keep interest rates at zero.
I remember yesterday on CNBC, well-known investor Dr. Weiss, he said that this is a crime for U.S. companies to invest in any China company. And these CEOs of U.S. and the investment funds investing in China, they should be immediately put in jail and never run investment funds.
From a political standpoint, I agree. Why would we allow our capital to go to that country when they're so aggressive? They threaten the world basically in many ways. I mean, Taiwan, they doing these games in the China Sea. They don't follow the rules. They steal our technology. In the long run, we should have disengaged with them financially, and it'll take years because now they have a lock on precious metals. They're selling taking away a lot of our manufacturing. Trump started moving the manufacturing back, but we need to keep taking steps because why do we want to be anything to do with them? We should say to them, let me just say this. We should say, look, you have your system, we'll have our system, and let's see what works. But why we'd want to be dependent, I have no idea. It really is almost criminal. And a company like Apple that uses slave labor and has all this business helping build their company, and it's just crazy in a way. But it'll probably straighten itself out over time when companies realize, and they're starting to, hey, wait, we need to diversify our chains. We can't depend on China. But they're very slow to react.
Maybe you're too young to remember the times of a Cold War when USSR was always under embargo and sanctions and just name it. And although there was a great rivalry with that time between Eastern Bloc countries headed by USSR, and it was right in open on a table and so on. So what's the difference between China today and the USSR of the 80s? Is because China is more dangerous today than USSR of the 80s? I don't think so.
No, I think USSR was more dangerous. You're right, Sasha.
Absolutely.
But you know what? And interestingly, China and Russia are having more and more business together. Russia's supplying a lot of China's oil. But look, it's easy to be united against something. The Democrats can all agree we hate the orange man, so it doesn't matter about the issues. They can all be almost unanimous in that. But when it comes to actual issues and realities, so the Chinese and the Russians have a common interest because the United States has been so successful in the world. So and along with some other countries that don't like it, so they have some allies. On the other side, they're right next to each other's borders, and a really powerful China might scare the heck out of Russia in the long run. But right now, their interests are probably more aligned, and the U.S. let the peace dividend fall through over the last decade or two. We had one last chance when Trump was in office for Trump to go to the Russians and say, look, why don't we make peace? And then everybody accused Trump of being in bed with the Russians, especially based on a conspiracy that Hillary Clinton and her group created. And it's coming out more and more now, even this week, which I knew for years and a lot of people knew, but it's coming out that how they plotted this. And now a lawyer who they worked with is under indictment now. This is a whole other story, but the bottom line is because of that, Trump couldn't talk to Putin. And so we lost a huge last opportunity maybe to try to work more with the Russians. So now we're kind of, alienated, and it's not good for the United States.
But see, the difficulties about cooperation between the U.S. and Russia, the difficulties are the trade is so minuscule, it's almost doesn't exist. There are no common grounds in any direction, whether it's even if you take some arts or politics or just anything, except maybe there is some rivalry, some meaningful rivalry, very interesting in chess. But besides chess, no common ground. There is nothing that is existing
Well,
in the
well,
world.
look, there is certain common ground. There could be a lot more. Let me put it that way. But it's water under the bridge right now. It would take years of diplomacy to, move forward to try to ally with them. But we have bigger concerns. I mean, the U.S. has a lot of issues itself now. The world is concerned with COVID, but China's the big danger right now to us for sure, because Russia's selling gas to Europe, and they'll have a lot of power economically. But China's the one that has the crisis because they have a demographic crisis that's even worse than the US and the rest of the world. They have a huge aging population. This is going to put strains on their system. And to a point, they're rational. I mean, they need resources. They need to grow to try to overcome what they have billions of people and an aging population, a declining workforce, and interestingly, more wealth inequality. I just read that. So they have big problems, China, and so they're going to be a little desperate, but that gets dangerous.
Hmm. Nick, what would you say about possible cooperation of U.S. and China?
Well, I think it's tough. I mean, we even have that problem at international broadcast media. Broadcasting into China is one of our few places we just can't get into unless you have a Chinese partner who's a majority owner. But China right now is starting to shoot themselves in the foot. Now, what do I mean by that? First of all, they're telling their young people, oh, you can only have 3 hours a day or a week playing video games. Boy, that's going to go really well. Then what they did with the real estate companies and with their own successful companies, they're starting to shoot themselves in the foot. But one thing we cannot ignore is they are the fastest growing economy in the world, and they are the second largest economy in the world. So we can't ignore it. But what Peter's saying is true. What's happening, the reason they're that way is the US corporations are buying the cheap goods they can over in China and coming to the United States and selling them at a profit. It doesn't take a rocket scientist like Nike to say, hey, we'll buy a cheap $2 shoe made in China and sell it over here for $200, or we're going to buy cheap computer chips over there and sell them over here at a big markup. So, and this has been going on for decades, that we buy the cheap Chinese goods made with inexpensive Chinese labor. We're the ones who are fueling their 8% growth rate because of that.
We're suckers.
Yeah, we're the one. Hey, Peter, we've been doing that for decades. In other words,
I have to correct one thing very quickly. I said Nike's the one who are definitely using the Uyghurs and slave labor. I don't know if Apple is, but the points are all good. You're right, Nick. I mean, why are we doing this?
Right. And so the thing is, the reason why they're so successful in terms of their fast growth rate is that the U.S. labor costs are high.
Yes.
Chinese labor cost low. Chinese labor markets, they work hard because, they're really, they don't have a choice because it's either starve or work. And so they've developed this big machine of working. And what's happening is a lot of capital has been drained out of the U.S. and other parts of the world and into China to the extent where we fueled the second largest economy in the world. And now we have to, unfortunately, deal with it. There's some good things. It did raise a lot of people that were destined for poverty out of poverty. Xi Jinping did a good job making sure that these people all didn't go crazy on him, which is hard when you have 1.6 billion people. And so for that standpoint, they've done really well. So their hats off to them. But at the same time, when it comes to doing business other than buying their goods, okay, if you want to sell something, like you want to sell,
forget it. China, it's not a fair playing field.
It's not a one-way street, dude.
And they're not going to play fair. They've never had.
It's not a two-way street. It's a one-way street.
If all of a sudden they're going to open things up and play fair, right. No. They cheat everywhere they can. No. And you know what? If you have 1.6 or 2 billion people, I thought it was 2, but whatever it is, right. If you have that many mouths to feed and you're in charge of the government and you don't want a revolution, it's like you're going to do whatever you can do.
Yeah.
So, but and it worries me because Marx said that the capitalists would sell the rope that would be used to hang themselves. Right. Famous Marx expression. I'm paraphrasing, but I'm concerned about that because maybe we have sold the rope, or maybe we're going to sell the rope. And then within the U.S.
No, we're not. We're buying the rope from China to hang.
We're buying the rope.
We're paying them good money for it.
but that they're going to use to hang us. So it's
Right.
not good.
Yeah, and I'm just saying, even from a media standpoint, Peter. In other words, like when I was in Italy, I could watch your show. I watched your show when I was in Greece. I watch your
Right.
show when I'm in Switzerland. China, no one can watch our show because they can just ban it like that. And if you want to get in, first of all, you have to go through their steps. Get a Chinese partner. They own 51%. You own 49. So they control everything that you do, and they control everything that you say. Okay, and see, that's the non-level playing field that exists in that particular country. With that, I shrug my shoulders and go, okay,
Um,
when is that ever going to happen?
of course, with so much anti-Chinese propaganda as we have today on our show, of course we would be banned.
Yeah,
in
yeah.
They wouldn't know. I wouldn't let it in if I was
crazy.
Hey, Sasha, we have the same problem with Facebook. Earlier in World Edition, somebody was bashing Facebook, maybe even you, and I'm sitting there cringing because our big distribution to millions of people is through Facebook. And Facebook, all they have to do is go, well, we don't like your content. They haven't done it yet, but they do it on other things. Usually, it's copyright issues and things like that. They can just turn us off and put the squeeze on us. Same with YouTube. So we have the same problem here. It's just a little different. We have to deal with the big tech companies. IBM, they took our whole website. I mean, just because we had a deal, the deal didn't exist anymore. All of a sudden, they go to wipe. We take the whole website. So when it comes to big tech, you have the same problem. You got to be really, really careful because they have a lot of power here.
We'll come back to Facebook. Just in 1 minute, we'll have our commercial, and then we'll come back to Facebook. I'll tell you something interesting about it.
Don't say anything bad.
Okay, coming back to Facebook. Anybody notice that the stock is down today 4%, whereas the market is trying to recover?
Why is that, Sasha?
No, I saw
that. And I saw all the other tech is up.
Yes, Facebook is down because it was essentially discussion about that they cannot manage a lot of anti-vax propaganda. They have a lot of misleading lies infested the Facebook pages, and that affects the health of many American.
Why would that affect the stock? Because they might regulate more of the content.
Oh yeah, sure. They will come down on Facebook. Really, I even suggested that it could be that Mark Zuckerberg will be accused and put in jail. We'll see if that happens. Hopefully.
No. What? You're not. You can't say that. Nick just told you that.
Well, he's been saying that all day. And the thing is, the good news is, Peter, is that a lot of their spiders and they have these web crawlers. They can't pick up all this stuff like what we say and what other people say. But if they do, then all of a sudden you get on their bad boy list.
Yeah, you don't want to get on the bad boy list even for a few days. Here's an interesting point that's amazing. Let me make this point. I want to make this point. So if you look at the S&P 500, you would not believe the makeup now. Like, people don't even know what they're buying anymore, which is good and bad. But the S&P 500 is 22% 5 companies. They're called the trillionaire companies: Alphabet, Amazon, Apple, Microsoft, and Facebook. 22% in 5 companies. Now,
and NVIDIA is knocking at the door too. Don't forget. NVIDIA is knocking at the door.
Oh, are they?
NVIDIA is trying
I didn't know that.
There.
I know they're a good company. So these companies are 22%. So when you're buying the S&P 500, you're not buying equal weight in all, hundreds, 500 companies. You're buying largely the tech. Now that's good in a way because I like these companies. I have options positions and Amazon, Alphabet, and Microsoft. I like them. Apple and Facebook, I'm a little more cautious about, but I take back Alphabet. I'm out right now, but I have had it, and they're great growing companies. They put a huge amount of money into them. Now, how much is the S&P 500 energy? 2%. So this is very small allocation to energy, and energy is where I think that now they're talking about inflation. Well, I think if there's going to be some inflation, I don't think it's going to be crazy inflation. I think it's going to come out in energy because, we're at, in the U.S., record oil usage. The energy companies are being very cautious about exploring. They've always had cyclicality where they've gone up a lot and then they do it down a lot. The prices go crazy. But now they're saying, we're not going to spend so much on exploration and development when prices are high because we don't want this cycle anymore. And part of that might be they're thinking, well, in 20 or 30 years, solar and other things are going to threaten our business. So we want to return some more money to capital to our shareholders, buy back shares, pay more dividends. So it's a change in how the energy companies are looking at it. But so this is why, and personally, I'm the opposite. I mean, I love the tech, but that's the only other place I really love. I love MPLX. I like TRP. I'm over 20% now MPLX, but I'm protecting some of the options because it's such a big position. I think it's unique. This is energy is not going anywhere quickly. It's going to be decades, and there's going to be all kind of problems in solar development. So on one side, it's interesting. On the other side, if you have the S&P 500 fund or many mutual funds, you have to realize you're just in, those tech companies, which is good, I think. But that's, people may not realize that.
Well, yeah, because of the weighting is more toward the tech companies than anything else on those. And I do have some of my funds that are professionally managed. I'm in those funds, and I kept thinking individually I want to get into that, but if they've already done it for me, I really don't care. What I do really like, and when Sasha announced the downward market, I went back and looked at everything I had, but most of them were dividend stocks, Sasha, and they didn't really take a big hit.
Yeah.
And then, like, my attitude is, of course, being in the pension business where we fight for 3%. And then also being on a homeowners board, we fight to get 0.6%. I mean, we're fighting for really tiny little numbers, 3% return, 1% return. And here you're showing me dividends that give 10% that look like to be solid companies. Exxon's at 6.39%. Tell me where Exxon's not a buy. I've already owned some, but I'm going, Peter, why wouldn't I buy more?
I know. If I didn't love MPLX and TRP so much, because I like the pipelines because they have the same dividends.
I do like the pipelines.
They have more safety. They're not subject. They have long-term contracts. They're more like utilities, but they're priced like the energy companies.
Right. And
ExxonMobil is very tempting to look at because
the pipelines are ridiculously good. The pipelines like MPLX ridiculously good, and I kept thinking, why would they allow such a large dividend? Well, let's analyze a little bit. First of all, there's no big growth in that stock. In other words, it's like, hey, we're like a pipeline. There's no sexy stuff they're doing. There's no innovation. So what they do is they give a big return based on the risk. What risk? The biggest risk they have is the government or a pipeline blowing up. That's about it. You can insure one and you can't control the other.
I've looked at the accidents, first of all, in the pipelines. They're very minimal. I mean, these are multi-billion-dollar companies, multi-billion.
Yeah, no, yeah, like Marathon.
And, if there's an accident, it's like, okay, we pay a few people off or whatever. And, in terms of innovation, actually, there might, first of all, I mean, you're right. In some ways, it's the same business, although the shale revolution was huge. But also now carbon sequestration may be a huge new business for these pipelines. As a matter of fact, I heard the second thing. TRP was already working with Pembina Pipeline on looking at carbon sequestration, because if you're going to take the carbon out of the natural gas or the oil, then you're going to have to ship it somewhere. You have to pipe it. So now there's more pipelines for carbon sequestration. And this week I saw another deal with EPD, which I don't own, and another company. I think it was a Canadian company too, and another, either proposed or they're working on carbon sequestration venture. And so shipping carbon may be another, so that may be innovative too. But Yeah, they don't need innovation because
Oh,
as
yeah.
long as you're going to heat your home with gas and maybe some people with oil, especially natural gas, because that's where my take is, my focus. As long as your house, everybody needs demand. It's called demand push rather than supply. No, demand pull rather than supply push. In
Yeah.
other words, it doesn't matter because people need it, so they have to ship it. As long as you need to heat your house, it's pretty safe.
It's,
Peter,
it's
I'd like to mention that thinking about MPLX, paying almost 10% dividend, very well, a very efficiently run company. And we believe always that the markets overall are very efficient, markets are always right. So, how come MPLX being a no brainer, essentially, paying
Yeah,
10% different, and people are not jumping at it, and so
actually, there is a reason for
the
that.
stock would go way much higher to $35 in no time.
Yeah, it
Yet,
should be. It should be at least 36. Yeah. You know what? There's a good answer for that. It's that it's a partnership. So not all investors are interested in that because, for an individual investor, actually, it's fabulous in many ways. You get return of
absolutely.
capital, depreciation. You may not pay taxes on it for 10 or 15 years. And so you get all your money back quickly. But it's very complicated accounting. So if you're a mutual fund, maybe you don't want to account for that, and then you might have to issue K1s to your. So look, even if you look at who invests, like who the big players, mutual funds are huge. Well, they don't want to issue K1s. The index funds don't want to issue K1s. Other countries are going to have tax complications too. So a lot of the players just aren't in there. You have a lot of a higher percentage of retail investors in these, but they're fabulous, and to me, it's the last opportunity really to make huge money safely. Especially in MPLX. I also like TRP, which, by the way, is not an. That's my second largest, but that's not a partnership, but it's Canadian, and I have find a lot of opportunities in Canada because the big money is in the U.S., but a lot of them don't deal with the Canadian markets. So I found a lot of dividend stocks and different companies in Canada where I think the ratios are better. Plus, it diversifies you out of the dollar, which is probably not a bad idea.
And don't forget that if you're right about energy, then Canadian dollar could appreciate versus US dollar. So that's additional kick in on investing in Canadian companies.
Yeah.
Possibly. I'm not.
Yeah, well, I've talked about it before. TELUS, I like a lot more than any of the American
Yeah.
companies with a dividend. They're nice, very steady growing dividend. And of course, TRP, really, I mean, these companies, they return capital. You look at their dividend histories. Okay, it's doubled or more in 10 years. It's like, and they've promised to do it again. It's like they probably will. So, which leads me, we have about a limited time now that the format is 30 to 40 minutes, but I might as well give my dividend pick since it's a Canadian company.
What
So
else?
today's pick is ACLLF. I have to put a footnote in there. Last week I mentioned Grief, GREIFB, which had a 4.4% dividend around there, and I got out of it. Very small. I told everybody like 0.25% anyway. But the thing is, I looked at them and their cash flow is great, but they haven't increased their dividend for 8 or 10 years, and the stock's been flat for 8 or 10 years. It's like I don't need a 4% bond. If I want a bond, I'll put it in a 1.5% or 2% bond or whatever. But for the risk, so I decided to get out of B. But okay, so this pick is ACLLF. It's called ATCO, Canadian Infrastructure and Utilities Company. First of all, I like the idea that it's Canadian because solar is probably not going to work that well in Canada compared to Florida, right? And two, it's got a 4.4% dividend. Price to cash flow is around 4 times according to TD Ameritrade, which means they're earning 25% a year cash flow. They've increased their dividend, depending on if you believe E-Trade or TD Ameritrade, by 11 or 7% a year, steadily for the last 5 years. According to TD Ameritrade, 11%. The revenue's slightly gone down in the last 2 years, but other than that, it was flat. But their cash flow is huge, and they keep increasing their dividends. And they own a company called Canadian Utilities. I don't know if you've heard it or not, but it's a huge company in Canada. But Canadian Utilities pays a 2% dividend. But they own, I believe it's 56%, a large percentage of Canadian Utilities, plus they own other infrastructure, but all natural gas and electric. So these are very safe, and if you look at my utilities, I want to be up north. I like the Idaho Power IDA, and I like Canada because I know solar is coming. So it's not going to work as well when you're up north. Less sun, and so it's less threatened. Certainly, an Arizona utility is going to lose to grid diversification if there is major grid diversification first. So, but ATCO looks great to me. So I put in 0.5% there, and I'll get my 4.4% dividend and probably double and double again in the next 10 and 20 years.
Mm-hmm. Well, excellent. But I have a strange feel that I would ask myself, actually yourself as well, a question. Would you sell MPLX and buy a CCLF?
No, that's why I have 20%. I have 20% in MPLX covered by options.
You get spoiled so quickly. It's the same
I
thing.
know. I wish I could find something like it, but 10%, I'd pay no taxes on it, for a long time, and I have some capital losses I can use up too. So, I mean, it's fabulous, the MPLX. I mean,
It is.
And the thing is, if there's any changes in the energy in the next 5 years, 10 years, 20 years with solar or with other things, they're working on something called fusion now, but it's probably going to take 30 years, but it could be a sort of endless power source, but it's going to take 15, 30 years. But if this way, I get all my money back in a lot more quickly. If I'm getting 10% back, 10 years, and I've already been in there for a while, but I'm just saying, you get all your money back and it's all profit, and it's,
Absolutely.
so it's great. Plus, they very well, I'd love to see a dividend increase from them. I know they have, their cash flow is huge. It's like 17%, I believe, net cash flow, something like that. They're easily covering their dividend. So they can buy back shares, but I wouldn't be surprised if they give a little dividend increase. And I even see that 5% of the market is short. I don't know why, because that's
mystery to me.
It could be options positions, but you know what? That they have to pay the dividends on that. Sooner or later, they're going to cover. Sooner or later,
Absolutely.
I would think so. No, there's no company like MPLX, that's for sure.
Peter, I must admit you're very resourceful to find the new ideas for high dividends play.
Oh, it's not easy.
It is not, because, but trust me, I was looking in that area too, and I've looked at a lot of stocks, and I cannot find anything better than we already own and discuss on the show.
Oh, I know. I may be running out, but the 25 investments I have or whatever, I could talk about them again because they're all doing well, and sometimes they have dividend increases. But yeah, it's very hard. It's very hard. And look, you have millions and millions and millions of retirees who are desperate for income. In the United States, not to mention around the world, not to mention retirees in Canada, and they're all going, I can't live in this yield desert anymore. I can't get. My retirement was based on a certain percentage, not to mention pension funds like Nick said, or all kind of things. It's like these people are going, I can't accept 1 or 2%. I don't want to go 10 years to get 1.3%. So what do? That's why the market is resilient and why it's probably going to keep going up for the next maybe 5 years, because the trend has been for 40 years declining interest rates because it's stimulating the economy.
Peter, think about what these retirees will do if there will be, God forbid, negative interest rates. So essentially, let's say they put their, say, $500,000 in a bank, and a year later they will have only 490.
Well, it's happening all in Europe and many countries already, because that's the ultimate stimulation. It's basically saying, put it in your mattress or put it in the market. Those are your choices, or pay us and we'll hold your money and you have to pay us. Well, the United States hasn't gotten there yet, but if you, again, take a 40-year straight line chart. So the market talks, the Fed's going to raise interest rates. It's like, it's all a bluff, and they probably will raise interest rates a little bit because, one, so that they have some maneuvering room and everything, but it's not, they can't have this kind of huge debt in the future and pay interest on it. And they probably know that if they looked ahead. So I would think they would know that, but they play this game. Oh no, we're going to raise interest rates, but they think, a quarter point in 22, no, an eighth of a point in 23. It's like, who cares? It's low, but I wouldn't be surprised, because if you look at the 40-year trend, by the way, it actually dipped below the 40-year trend, even though it's been steadily going down during COVID. but now it came back. I'd have to look at where it is, but that would, if we're, we're probably slightly below where that trend line is, which was such a straight line. But once we get to that, it'll just continue going down because we're going to stimulate the economy because of demographics and technology and everything else that's all deflationary.
Peter, it will all come down to the looking for investment opportunities. We have to look at the mattress manufacturers. I think
Yeah.
well in the next few years.
You keep your cash in there.
Yeah.
Yeah, it's not much of a return. Well, that
Yeah.
gets back into gold and other things, which only holds value relative to, low cash.
The only alternative to mattress, I see the Bitcoin and some
Oh, no.
cryptocurrencies.
Yeah.
But even that is not solution because
No,
actually,
you know what? I'm very anti-Bitcoin, in terms of, I think it's just like tulips in China or Beanie Babies, by the way. This is another one. I forgot about this, but I saw something this week about that. So tulips in China, in Holland, were going for $200, and then they collapsed down to $0 or $5. But Beanie Babies I think it was the 90s. All of a sudden, Beanie Babies got hot. It's like, we're going to trade Beanie Babies. So they went up to thousands of dollars for some of these Beanie Babies. And now they're back to like $5, which is what they started at. So, these trends come and go. But with Beanie Babies, the government could say, okay, we'll let it go. But with Bitcoin and crypto, with 7,000 cryptos now and doubling the market, every 2 years and keeps growing, the government can't allow this to happen because they're going to lose control of their monetary supply. The U.S. will lose dollar dominance, and they know that. And they're not, and a lot of politicians have made negative comments already, including Janet Yellen. But once, I want to see what happens in this infrastructure bill, because they are saying that they're going to have all crypto transactions reported and taxed. And what is that going to do to the market? Oh my gosh, Bitcoin is it could, it may not, but to me, it'd be like, once people start getting out, it'll be a panic. So, and that's why maybe it's at 43 today. It was in the 50s before. It was, I think, as high as 60. But when that bill goes through,
yeah.
What?
It was 65 at one point.
Yeah, somewhere around there. Yeah, it's so volatile because there's no fundamentals. So, so I want to see what's in this bill, and when it comes out, I think something will be passed eventually, even if it's the smaller infrastructure bill or a medium one. Who knows what Manchin and Sinema agree to? They shouldn't, but they probably do something halfway, which it's halfway of more debt than we need. But they should also pass something. So. In any case, when it comes through, if it has all these rules, how many people are going to say, "Hey, I've made $100,000, or I've made $1 million, or I've made $50,000"? I think it's time to walk because it's going down fast, and and the smart money would probably say be ahead of the bill as they're signing it. They'll already be pulling out. So we'll see what it does to the market.
Okay, we'll definitely discuss it next week for sure. Thank you so much for today's program. And this was IBM TV Financial Show. My name is Sasha Starr. Thank you very much, Peter, Nick, and we'll see you next week. Bye-bye.